Okay, everybody, it's been a wild 36 hours here. We're going to get into Silicon Valley Bank imploding. The FDIC has shut down Silicon Valley Bank, and there's many different things we have to discuss. With me today, as always, the dictator himself, Chamath Palihapitiya, the Rain Man, David Sacks, and the Prince of Panic Attacks No More, his wired's cleared, David Friedberg, the Sultan of Science. Welcome, boys. How is everybody, just to start this off, contextually, the last 24 hours, can you recall a time in our careers where it's felt this acute or insane or intense?
2008 and COVID.
Okay.
And I think that this is right up there. Could be 2, probably 3 in terms of the level of panic and concern. The problem is we're in the middle of it. We don't know what's going to happen this weekend. So there's a lot of anxiety right now, a lot of panic going on, and a lot of, unlike COVID and '08, really acute effects that many companies and investors are actively dealing with right now. Not just a few, thousands of companies that are really in a state of distress right now. So it is potentially, from a Silicon Valley perspective, worse than '08 or COVID.
Oh, for sure. For sure. I mean, this is basically a Lehman-sized event for Silicon Valley. Remember when Lehman Brothers went out of, basically filed for bankruptcy in 2008, started the whole financial crisis. The federal authorities thought that the best plan for Lehman was to file for bankruptcy. They didn't try to save it. And that basically led to a cascade where the whole financial system almost collapsed. I think that SVB, this is a Lehman-sized event for Silicon Valley. And there's 2 big things happening. One is the impact on the startup ecosystem. So you're seeing probably thousands of companies now cannot make payroll in the next few weeks because their money is trapped and tied up at Silicon Valley Bank, which is now under receivership. So if you wired your money out yesterday, you're good. And a lot of people managed to do that. But there are a lot of people who had wires in the hopper, didn't make it. Today, logged into the website, can't log in. Their money's just frozen. And we don't know when they're going to be able to get their money out or how many cents on the dollar you're going to get. So basically, the whole startup ecosystem is in peril. I think Gary Tan called it an
extinction level event.
Yes, exactly. That was a good term. And just to be really clear, this is not big tech at risk. I know there's a lot of people out there who don't like the idea of bailing out big tech.
This is not Google. It's not Amazon.
Exactly. Those companies have plenty of cash. They're fine. This is small companies with 10 to 100 employees. And you're looking at maybe thousands of them just being wiped out for no reason. They didn't do anything wrong because of this. This could have a very damaging effect on the startup economy and the whole United States economy. This is little tech. These are the future companies that will keep the United States competitive versus China and the rest of the world. And then the other big thing that's happening, and this is all happening in real time, is a regional banking crisis. Because when depositors see that their money was not safe at SVB, which was a top 20 bank that, as far as everyone knows, was in regulatory compliance. Nobody has said that SVB wasn't compliant. As far as we know, they had a regulator's seal of approval. And now you find out your money was not safe and it's not FDIC insured above $250,000. So the conversations we're all seeing in our chat groups with leading investors is, why the hell would you keep your money anywhere but JP Morgan or a top 4 bank? And so I think that unless the Fed steps in here over the weekend, we're going to see potentially a run on the regional banking system, a cascade like we saw in 2008.
Well, Sacks, let's just take a step back because I think that you're right, but we should talk about why that happens, the contagion drivers.
And just so people know, Silicon Valley Bank is used by 50% of venture-backed startups. And I would say the majority of venture firms also have their money there. So this morning, I got a note from a fund I'm an LP in. They had millions of dollars that they can't access to invest in startups. So Chamath, there are many products and services that Silicon Valley provides. One is, banking services to startups. Another is to venture capitalists. They do the mortgages for venture capitalists and for founders as well. They provide those kind of white glove services. But you also mentioned in our group chat, they also provide loans to GPs, general partners, to people who run venture firms. So the impact could also hit there. Maybe you could explain what that is. And then we'll get into what happened here. Yeah.
Well, I think it's important maybe actually just for Friedberg to just explain what's happening. But
Okay.
Maybe let me just do the lead in and then Friedberg can do the details. But for those that are far away and aren't even sure what's going on, the basic problem that we have right now is in the last 36 hours, a key part of the financial plumbing of Silicon Valley has basically been turned off. And as a result, billions of dollars of deposits have basically been frozen. It means that people can't pay their bills. It means that people can't access their deposits. It means that credit lines could be in default. It means that payroll can't be met. And so as a result, we have this potential contagion on our hands. But in order to understand it and unpack it, I think it's important to explain exactly how this came to pass. So let me just hand the ball to Friedberg and then we can talk about some of the implications, of which there are many.
Yeah. Before Friedberg starts with the why, just the what that's happened as well. This all started on Wednesday evening when Silicon Valley Bank's CEO published a letter to shareholders announcing that the bank was rebalancing its balance sheet by selling tens of billions of dollars worth of mostly U.S. treasuries. And then they announced they would raise some money and sell some shares in Silicon Valley Bank. Then the shares in Silicon Valley Bank as a publicly traded entity dropped 60% on Thursday, then another 60% on Friday. Of course, then the entire world got focused on this, and then every venture capitalist started telling, or I would say the overwhelming majority of venture capitalists told their founders to get their money out of SVB. Then you had a classic run on the bank. A small number of venture capitalists gave advice to say, hey, we should support Silicon Valley Bank. I understand that, but it turned out to be really bad advice. And then trading was halted on Friday morning pending news. And then finally, the FDIC shut down Silicon Valley Bank at noon on Friday. And there's a lot of speculation of what will happen on over the weekend. But maybe you could walk us through technically what happened to Silicon Valley Bank and why they had this cash shortfall. And this, we explained the run on the bank basically, but what led up to this?
The irony is it really was and is, prior to the quote run, a financially solvent business. So I have a few slides. If you're on YouTube, you can see it, that we pulled one slide that was kind of made by us and the other set that come from Silicon Valley Bank's actual presentations. But if you look at their balance sheet, this is from the end of the year 2022, you can kind of look at the stuff that they owe, their liabilities, which is what they owe their customers that sits in deposits. Because when customers give you cash in a deposit, you owe them that money back. So that sits as a liability. And then they had some other debt. So in total, Silicon Valley Bank at the end of the year had about $195 billion in liabilities, $173 billion of customer deposits that they owe to customers and $22 billion of other debt. And then they take those customer deposits and they invest it in a number of securities. And the way that a balance sheet business like this bank would operate is, the customers have access to their cash anytime they want. But in order for the bank to make money, they make longer duration investments. And those longer duration investments give them the ability to earn money on those longer duration investments more than they're paying the customers for the deposit. So if you look at their longer duration investments, they had about $208 billion of total assets sitting on the balance sheet. So compare that to the $195 billion that they owe customers and other debt holders. So, the difference here between 208 and 195 is about $13 billion. That's kind of the net, what people would call book value of Silicon Valley Bank at the end of the year. And of the 208 billion of assets that they had, 74 billion were loans, and they've got a breakdown of the loan portfolio here in a minute. 91 billion were these hold to maturity securities, where they don't actually adjust the value of these on a quarterly basis. And 26 billion is what triggered this panic, which is available for sale securities, mostly treasuries. And what happened is Silicon Valley Bank's deposits came in so quickly over the last couple of years that they went out and they bought a bunch of treasuries, with the cash that they got. And the problem is that very quickly...
Friedberg, it's actually MBS. They bought a bunch of MBS, 10-year duration MBS.
And important to note, of the 208 billion that they have the book value, Friedberg, there was a 10% of it's in cash or something. So they do have some cash there.
That's right. Yeah, sorry, it's a good point. If you go back, so let's say that of the 173 billion of customer deposits, they've got 14 billion of cash, and then they've got all these treasury securities they can sell, call it 40 billion. So if 25% of customers said tomorrow, hey, we want our cash back, theoretically, they could just dump those treasury securities, distribute the cash, and give it all back to customers. The problem is if suddenly more than 25% want to get their cash back, well, now they have a problem. And is effectively what triggers the run on the bank. As soon as some folks think that others might be pulling money out, then everyone rushes to be the first money out the door. And that's what triggers a classic run on the bank. There's a statistic, I think, in the 1920s, there were several hundred banks that had runs every year for almost the entire decade. And this was like a regular kind of occurrence that happened in the 1920s that ushered in a lot of our modern securities laws that are meant to kind of create the necessary liquidity provisions in how these banks are able to operate to make cash available to customers. But what happened is...
So much so, by the way, Friedberg, that they made a movie, It's a Wonderful Life, about a bank run.
So basically, one of the bigger problems that Silicon Valley Bank, they ran into two big problems. Number one is deposit decline, where VCs were not investing new money. And when they were not investing new money and startups were burning more money than Silicon Valley had modeled they would be burning, because they thought everyone was going to reduce spend and reduce burn, and they didn't. So deposits were going down while all these startups were burning money. No VCs were investing. So total deposits were on the decline. Meanwhile, their bond portfolio, the assets that they hold on the balance sheet, also declined in value. And I kind of just put a really simple illustration here on why. If you have a $100 kind of face value bond that earns 2%, which is basically, where these treasuries were a year ago, and you hold that for 10 years, that 10-year bond yields $122. If the interest rate goes up to 5%, then that bond should yield $163. So the value of the first bond actually goes down by 25% because of the market conditions. That's how significant the value changes with just a 3% change in the interest rates. And that's effectively what happened with that available for security segment of the Silicon Valley Bank portfolio balance sheet. They had this bond portfolio that suddenly got devalued, and they had declining deposits. So when deposits start to decline, you got to make sure you have enough assets sitting on the balance sheet. So they sold a bunch of them, said we're going to raise more money. And at that point, everyone kind of perked their head up and said, oh my gosh. What's crazy is in Q4, by the way, Seeking Alpha, this website you guys know, they had actually done an analysis and said, is SVB about to blow up? And they put together a bunch of slides that highlighted why this might be the case, because they saw that deposits were declining, that their assets that they hold were basically declining in value because of the massive and very quick rise in interest rates, and that SVB had bought a bunch of bonds that were long durated bonds. So it led to obviously a real short-term problem. If you look at the rest of SVB's loan portfolio, there's also a question of how distressed that all is. So 10% of their $70 billion plus of loans is in venture debt. And venture debt is very questionable in this market, right? Because historically, the way venture debt makes money is that they assume that VCs are going to keep funding the companies that they're providing debt to. And if the VCs stop funding the companies, then the venture debt defaults. And so if you go to the last slide in this deck, you'll kind of see SVB's performance on their venture debt portfolio. Yeah, so look at this. This is the performance results on just the warrants that they get on their venture debt. So when you issue venture debt, you take a write down or you get paid back. And then you also get some warrants. You get a right to buy shares in the winners, in the startups that work. And so the way that SVB's made money on their venture debt portfolio historically is hopefully they get paid back on all their loans. Some of them they don't. But then they'll make a bunch of money on selling their warrants or the companies going public or getting bought. And in Q4 of 2022, it just fell off a cliff. And their venture debt portfolio really started to show distress. And that's 10%.
Are these realized gains or these are mark-to-market gains?
This is the net gains on their warrants. So they don't mark-to-market warrants. I think this is what they actually exercised and got out. So there was obviously a ton of exits in 2021. So they made $560 million in profit on their warrants that they had in their venture debt portfolio in 2021. That number collapsed to 148 in 2022. And you better believe most of that was in the early part of 2022. So they didn't do a quarterly breakdown on this. This was like their full year numbers. But their venture debt portfolio, which is another $7 billion of capital, also distressed. Certainly wasn't going to perform as everyone had modeled. So when you kind of start to add this all up, and remember, if you go back to the beginning, they only had $15 billion of true net book value, which is the difference between their assets and their liabilities. And so if you really start to adjust, what are those assets really worth? Are they really worth what they're holding them at the book at? And if people start to pull money out and you got to sell them at a distressed price in order to give people their cash that they're owed on deposits, that's when you have a classic run on the bank problem. And then everyone tries to be the first out the door. And that's basically like what triggered this week.
Can I give you guys my little version of all of this? I think there are 3 buckets, but before I go into the 3 buckets, I just want to say to all of the employees at these companies, I think we, the four of us, are so truly sorry for what's going on and what you guys are going through. And then to founders that are trying to navigate this, it must be unbelievably tough. There are a few founders in our portfolio. So, from all of us, just know that we're thinking of you guys, and hopefully everybody ends up on the other side of this by Monday or Tuesday with not a lot of damage. So let's just put that out there as sort of like goodwill and kind of good juju in the world for the next couple of days.
This is going to be a really
here.
difficult weekend for people who are trying to navigate this.
Yeah.
I think it's well said. Yeah.